Michelle.oddo with the Oddo Group, Illuminate Home Loans. What the heck is going on? Inflation came in double what was predicted. Gas prices through the roof. We have all kinds of crazy things happening. What does that mean? For more videos like this, like, share, and subscribe. Subscribe on our YouTube channel. Be a subscriber that gets weekly mortgage advice. Interest rates will most likely go up. Our old buddy, Janet Yellen, has said so herself. She predicts rates to go up, and that's the Fed talking to offset inflation, or what they predict to be future inflation that's coming down the pike. So what does that mean for you? Well, if you have a home equity line of credit that is tied to prime and has a revolving interest rate, which all home equity lines of credit do have a revolving interest rate, then it's a good time to think about combining that with your first. What if your interest rate on your first is a little bit lower than today's interest rate? Doesn't matter necessarily, because depending on the amount of your home equity line of credit in relation to your first mortgage, that might create a much higher blended rate than just what's on your first. So if you're only focusing on what the rate on your interest rate is on your first mortgage, and you're totally dismissing what the interest rate on that HELOC could go to, depending on what prime does, and if you look at history, prime over history, go back into the 80s, can go way, way, way up into the 12, 18% interest rates. So if that HELOC is tied to prime, and we go into a high interest rate environment, and that interest rate starts going up on that home equity line of credit, you no longer have the interest rate you have on your first on your overall home monies. Does that make sense? What I'm saying is you have to look at the blended interest rate of the two loans combined, because that's technically what you're paying in interest on your home on monies borrowed. So it may make sense to combine those, put them into one mortgage at today's rates, get it fixed, get it fully amortized, and get that thing on a path to payoff versus a revolving, interest-only, adjustable rate home equity line of credit. Doesn't always make sense. Some people like to have that home equity line of credit because they make big commissions, or you get big bonuses and you feel like you're going to chunk that thing away. Great. If you're paying it down and that's working for you, by all means, that might be the right thing to do. But most times what we see is on these home equity lines of credit, people get into them with great intentions, and what happens is that they only pay the interest-only payment. And they do that for 5 years and 10 years. And the loan balance doesn't go down. So if that's you and you are nervous about what rates might do, give us a call so we can combine your two loans and get you into a better position. Maybe even give you more cash out depending on the equity of your home right now. So Michelle.oddo, the Oddo Group, Illuminate Home Loans. We'd love to help you strategize. Just look at your loans and see if where you are right now is the right place to be in terms of how your loans are structured.